If we put 2015 annual as a bar in this chart, it'd be 10.9 local, 10.4 US. So you can just see what happened, post 2015. 2015 calendar with the numbers I just gave. So the volatility we've seen is 16.
But I think the next point, a client can choose. You want the left bar, you want the right bar. Now with an FX overlay, you can let the client decide and own the left bar or the right bar in the future.
And many of our clients in Australia and Canada tell us, don't hedge because I'm already doing a portfolio overlay. So some of this is just the market, so put it in the client's hands.
Right. Well, especially I think for American clients, right, who may not be invested yet, who may look at this performance and say, well, why do I want to buy something at 4% or 5%? You can say, look, you can choose and buy the one that's at 8 now if you want, and that way you're sort of not advising the client whether they want to do an FX bet or not. Which Paul and I have debated this many times, whether over a 10 or 15 year period, is it a benefit or not a benefit, or is it just ultimately an expense? And each client probably have their own decisions there too.
Yeah. Yeah, and the short-term numbers our investors aren't really focused on, to be honest, in terms of total return. It's always about yield in this space. So over the page, on page 9, this is a really good chart for talking about diversification against other risky assets. So there's no endpoint bias here. This is the beginning of the fund through till the last quarter, and you can see the performance. Against equities, fixed income, US private real estate. The two lines with boxes on them. So the top line is local currency returns, and the bottom line is US dollar returns. So you can see the pronounced impact of US dollar strengthening. But interestingly, for a US dollar investor against these other asset classes, if you're looking at a relatively long-term exposure, beginning in 2006 and walking straight into the crisis, I think it's an important chart for showing that core infrastructure did the job it was meant to do in terms of diversification. Continuing on, page 10. So one of the things we've talked about in the past is, we often get the question, it seems like a pretty frothy market. There's a lot of allocations to infrastructure. We see trophy transactions take place, expensive prices, and we've talked about, our desire to avoid options. So this is the most recent data for time spent since 2013, and over half of what we've done has been privately negotiated, and we've avoided auctions. And the US market is a great market for being able to achieve that. Very difficult to achieve in other smaller markets. And this is something that is a really attractive, selling point to new institutions who've spent some time thinking about the space and are concerned about the frothiness in pricing. Second point is, second chart on the right is platform. So again, the concept is in a fragmented market like the US in terms of water utilities, for example, 650 water utilities in California. There's 25 in the United Kingdom in total. In California, we think is a fantastic state from a regulatory perspective, even for water, despite the drought situation. Being able to put together a board of directors that's focused on a growth utility, a management team that's incented to deliver against growth and these returns is something that takes quite a bit of time, and I think we spent a lot of time on that in the US and very happy with where we've gotten to from a governance perspective and effectiveness, which is now borne out by the fact that these platforms are up and running. And don't get me wrong, the first platform expansion, has some nail-biting moments and plenty of lessons learned to kind of walk through after the event. But the first time you've been through this with a management team and a board and they've made their acquisition and integration is going according to plan, you get a lot of momentum for future opportunities. The other thing is it's a big market, fragmented, but relatively small market in some ways. A lot of the opportunities we see away from auctions are driven by the reputation that we've achieved for being able to bring platforms into a better story for their own future. Small targets on the platform. So this is really where you can expect us to spend our time. It is truly differentiated. You'll hear a lot of people talking about the mid-market. This is, the proof in the pudding. We're in the mid-market and we're buying a lot of platform businesses and we're hitting our targets. So that's good. In terms of some examples over the page on 11, we've been very active in the US in renewables, as you know. Particularly wind in 2016, and recently solar. We've taken a global solar partner out of the operating partnership we have for solar. These are in the US, and particularly in wind, you're looking at 24 to 25-year contracts. So these are very long-term contracts, quite unique around the world. We're at utility scale now. It's a great opportunity for partnership in terms of co-investment, which is increasingly on the menu for large sophisticated institutions looking to do a fund investment alongside co-investment. And if you think about some of the other geographies that we spend a lot of time in, Australia, Canada, the US, where you've got allocations that are growing and assets under management that are growing, a platform investment, a direct investment alongside a fund investment is a really interesting proposition in terms of avoiding dilution and being able to put more capital directly into the direct investment as well as into the fund over time. And that discussion is getting a lot of traction and can create very tight partnerships with LPs. So there's some examples here. I won't walk you through them, but they're all mid-market and largely platform. We're excited about the pipeline that we've got in platform as well, which is really how we've been able to tell investors that the queue is really a 3 to 6 month discussion. 6 months would be conservative, but it's been under 3 historically. We'll be growing at about $2 billion a year raised and invested, and expect about half of that to be put through the platform, which is a really powerful statistic.
Well, can you maybe just walk through like a wind farm or something, like how you say a 20-year contract? We own the turbines. We're committed to sell so much electricity, or someone committed to buy. Can you just talk a little bit about what that means?
Sure. So typically you've got, so where we like to enter the market is when a developer has done all the really risky work. So finding the land, leasing the land or buying the land, negotiating an offtake agreement, a long-term agreement with a very creditworthy counterparty like a utility, and then procuring the turbines, organising transmission, and O&M contracts. And we're happy to take a little bit of construction risk in the simpler asset classes around construction, particularly solar and wind. And then we'll sit and operate the platform with a 24-year, 25-year offtake agreement. We'll have debt in place that amortizes through time. If you think about, the one thing you know about owning a wind farm is that it's going to be worth nothing at the end of 25 years. And so it's very much about getting cash out of the asset. You don't have a lot of inflators in revenue, so yield and total return should sit right on top of each other. And you saw us take advantage of this in the yieldco market. We bought a lot of assets off public yieldco. So I think we talked about this in the past. That, the basic proposition of a yieldco was buying operating assets off developers. And so you've got assets that amortize to zero, but the promise to the public markets was around yield and growth. And I think ultimately that story was going to begin to come undone, and we were there to take advantage of it. So that's wind. Solar is very similar in terms of long-term offtake agreements. You don't get a lot of inflation protection out of wind and solar, so about 25% of the portfolio doesn't offer a lot of inflation, but transport and utilities do.
Perspective, are you seeing anything come out of the closed-end space, or has that decreased a bit?
It's a good question, and there is a relatively steady flow, but always auctions. Very difficult to negotiate an off-market transaction when a financial investor is selling. So we don't anticipate a lot of those to be relevant to us. There's a couple of trophies coming out as well in the US, so you won't see us around a lot of those things. Over the page, ESG. So this is something that is very important to infrastructure investors in Australia and Canada. I think increasingly important here. Our starting point is UNPRI. Obviously, as we all know, the firm is the signatory. We took the step of being extremely transparent around UNPRI and reporting on each one of the principles and kind of grading ourselves on each one of the principles. And if you take the time to read the principles, frankly, they should be taken into account. Being a part of your community, thinking about communities and effectiveness of governance, absolutely should be taken into account in both sourcing transactions and managing assets. So we report very transparently on that. Infrastructure is an asset class that lends itself to ESG, particularly environmental. I think we also push very hard on governance, as we've talked about, and sustainability. At the end of the day, you're an asset that's serving families, and you need to be an active member of a community. We've got great examples of that. We disclose them in every quarterly and in the annual. We got an A rating in our 2016 UNPRI initial assessment, which is a pretty high rating. And again, we'll look to work very hard to maintain that and improve that. We've joined GRESB, and from a governance perspective, each of these companies has a board of directors. It's It's members of our team accompanied by independent non-executive directors. So these are leading